This is the headline that's garnering all the attention today.
All the evidence shows there's a investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Lucian Gindorf, and this is A Steward's View. So good to be back with you. You can check out this week's economic and market roundup today at astewardsview.com/blog. That's astewardsview.com/blog. Today we have a special episode. It's called ASV Plus. And in ASV Plus, what we do is we take a look at more in-depth investment concepts, things that are maybe not in front of you, particularly you if you're self-directed as an investor, or maybe working with a newer professional or professionals. So I want to kind of dive in deeper into investment work that can go on in support of optimizing assets. And again, ASV Plus is sort of a special effort that we want to bring to you to call out some of the concepts that are more advanced to support you in your walk as you seek to steward assets that are yours for a short time. So I wanted to go there today. So normally, again, these are unfelt needs for investors. Our overall purpose is, just zooming out. We want to look at economic, investment, and planning points of knowledge that we can contribute, hopefully useful information for you in your decision making, and then take a look at adding wisdom needed for excellent stewardship. So that's it. Our mission here on ASV is to help you level up your decisions and really to get you in a better position to be wise and decide well. So before we get going, let's take a minute. Let's examine our work in the context of God's word about stewardship. And Lucian, there are a couple of different verses or sections of scripture that I'm combining here on purpose, but I think it'll make sense as we go along. Hebrews 13:5 says, "Keep your lives free from the love of money and be content with what you have, because God has said, 'Never will I leave you, never will I forsake you.'" Matthew, we hear Jesus say, this is the Gospel of Matthew, chapter 6, 31-33. "Therefore, do not be anxious, saying, 'What shall we eat? What shall we drink? Or what shall we wear?' For the Gentiles seek after all these things, and your heavenly Father knows that you need them all. But seek first the kingdom of God and his righteousness, and all these things will be added to you." So the idea of God being enough, and then, earlier in the first verse from Hebrews, the idea that he's always enough. So we have this not forsaking, this constant presence. We have this sufficiency, right? And listeners from last year would have heard Hebrews 13:5, and they would have also heard, I have a particular love for the Old Testament description of God the Father called El Shaddai, that calls out the sufficiency or the sufficient one, right, of who he is. So that's a major set of comments in these core verses that can help us set the stage for the idea associated with a steward's view. And that is that we are managers. We're not the ultimate owners of our financial picture, not the masters of our own destiny, as is commonly thought. So our financial resources then can just be considered ours for a short time, and our decisions can flow from that perspective. So with that wisdom in mind, let's take a look at our core content for today. I'm going to pull up a case study that I was really kind of challenged by. This was is a couple that just, last week even, we're sitting here on Monday, June 22nd. So this would have been Friday. That was 3 days ago, the 19th. I got to just the privilege of delivering news to this new family at Fideer Advisors, the advisory firm that I operate, and was able to share with them how ahead of their retirement funding goal, their retirement funding or their ability to retire, that they actually are. And the joy in that conversation. Such an exciting thing to watch them light up as they heard that, as they realized that they had a different set of challenges than they thought initially, right? The initial challenge was, when can we retire? When can we retire? What does it look like? How do we, gain more traction in other areas of our lives besides just working all the time, right? Repurposing things, ... Here are our life goals. It was brilliant what they were after, right? Just beautiful. But then, suddenly the challenge wasn't, can we do this? The challenge, how are we going to take the $2.5 million that we put together? That's really, we have a modest lifestyle. We only need to take about a 3.5% withdrawal from that $2.5 million in order to fund our normal, routine living expenses, all in. So that withdrawal rate is very reasonable. And what it meant in their case was that their new set of challenges was, gee whiz, worst case scenario, we're going to end our life together. This is a husband and wife, right? First marriage. We're going to end our lives with no less than $4.5 million. And that's if both of them have long-term care events. So what are we going to do with the $4.5 million at the end? Right? So the estate, and more than that, the legacy associated with that estate, way different conversations. So getting to that was about a 2-month process in their case, right? From the moment we started doing their kind of initial conversations and they came on board, we looked at the portfolio, and that's the piece we'll look at right now. But I want to highlight how incredibly rich that conversation was with them just last Friday. So, in very common, by the way, we worked so hard, we did such a good job, we delayed gratification, we built up an asset base, and by the way, they're only 51 years old. My goodness, way to go! Good job. They know who they are if they're listening. But the comment is, just briefly before we dive into ASV Plus here, the planning point, and I talk about this a lot in our offices and client meetings. That's the trade-off between the retirement plan and the estate plan, right? It's a teeter-totter. Okay, there are two different sets of taxes there, right? State and federal, and there are two different, related to the asset base and income, right? And then there's also just the asset base, and how do we, if we're going to not spend it down in retirement and even grow it incidentally, in the case of this couple, what does that mean, if the teeter-totter's way up at the end, right? Their upside was 3 times the worst case scenario, right? So what if we have $10 or $15 million at the end? Oh my goodness. So there's some really neat things that happen when we start to go into the planning aspects of this. But before we got there, I'm very, very happy to say that there was some hard work done on the investment piece. And I can't think off the top of my head how many accounts are represented here in this analysis I'm going to share, but it was about 5 different account types and titles, some his, some hers, some theirs. And what they found out, and I'll refer back, I don't remember the exact episode name. Maybe Lucian can, bring that at some point. But the conversation about, I think I was picking on dividend investing, if I'm right. And it had to do, anyway, portfolio optimization, right? One of those conversations we had late last year or early 2026. And, nobody sits, and this is right where we are and right where they were, right? So we're going to be in this kind of conversation the rest of this episode today, almost nobody, I can't say nobody, but I'm betting nobody sits at the Thanksgiving table and goes, and here it is, here's their number, their cumulative return over a 5-year period ending May 31st, 2026. And we are going to unpack this in detail that I would think portfolio managers will appreciate and advisors would expect. So 5 years through May 31st, 2026, the cumulative return for this portfolio of 5 accounts, the sum was about 2.2 million in this analysis. I think the final retirement number was like 2.5. But the 2.2 million analyzed across accounts overall rolled up. Cumulative return 32% over the last 5 years. Okay, so we can do that math. We can figure out what the per year is. Here it is. If I'm right here, 5.77. So then we go to, two other, metrics. We talk about the optimal model, which is a whole conversation, but Fidier presents, my firm, the sponsor of this program, presents an optimal model, right? Does that mean that it's the perfect thing? No, there is no such thing. But it's optimized to try to improve the relationship between risk and reward. And for the people who are very technical and maybe even trained in this, I'm looking at first at 5-year Sharpe ratios with lower standard deviations or some other variance-based risk measure. Okay, and that's how I start building an optimized model. And by optimized, I mean I'm looking at multiple layers of optimization. Okay, so I'm looking for asset managers, typically active, and then I'm looking for those who are historically, we can only look back historically on risk, doing a superior job. So less risk, kind of playing golf, if you will, versus their peers and versus their category or their area of the global marketplace. So that's to say that an optimized model starts with for my firm, starts with managers that are doing a conservative job. They're managing risk and they're keeping up on return. All right. Then I want to, and I can even zoom out one more layer, but I'll try to just blend this comment in that the managers themselves, I've already identified where in the world I want to invest, right? And the way that I've identified where in the world I want to invest is by looking at what asset classes are lowly correlated or negatively correlated, right? What's an asset class? Okay. Areas of the market. So where in the world can I invest that I'm not going to just repeat myself by investing in the next place, right? Where I have actual diversity, if you will, in the behavior of asset classes compared to each other, and then a healthy dynamic as far as the way those holdings move together. And the correlation matrix is the key to this. It's not rocket science, but it is an extra layer of work to figure out where that is. So I've already done that. And now I'm saying, all right, well, in our case, it's about 15 asset classes that we're in. It's been that way the last few years. In fact, that's the number. And now we're going to say, all right, I want to know which managers are doing the work of dialing down risk and keeping up on return. So when I find those people, those teams with a track record, and I pull them together, right, then I go another layer and I say, all right, well, how is this overall, this aggregate, right, the 15 management teams together all over the world in the areas we're going to be in, how are they done on that risk score, right? So it's a secondary kind of roll-up risk score that I want to be, improving somehow versus what? Versus a very relevant set of global benchmarks. Okay. So I would encourage for the PM types that listen, go ahead, and we use the Dow Jones S&P Global Series. There are 14 benchmarks in that series that compare to, at at the moment 15 asset classes that my firm is using, but it could be 12 or 16. It's just looking at that R squared, that correlation coefficient. Do we have something that's relatively high? And I would submit to you that in the case of our 5 models, conservative through aggressive, that we're above 90 in the R squared department. Okay. So that brings us then to what I mean by an optimized model, right? So that work has been done. We know what this model looks like. You can visit Fidere's examples at Fidere Advice. That's FIDERE advice.com/models. But, in addition to that, then we also want to be comparing to the market. So this client, before their retirement, mini celebration that we had last Friday, a month prior to that, we had these conversations, and it went like this. All right, well, you've generated 32% over the past 5 years. Great. Who's complaining, Lucian? Well, I've got 2.2 million now. We can discount that by 32.5% over the last 5 years and figure out how much we started with, right? With or without inflation. Nobody's complaining about the 32%, but the issue is that when we look at the optimal answer, I mean, yes, hindsight is, all we've got, but man, it was 42%. And the marketplace was at 45. So I didn't say that on performance that our models were always going to win. In fact, I can't say anything of the sort, or I'll get booted out of the industry that I work in. But I'm trying to express that this is not a performance analysis only. It is, though, when we do this exercise, I'll post this without a name on it out at stewardsview.com with our weekly blog tonight, so it's visible. But while nobody's complaining about the 32%, it's also not clear during the same 5-year period that, gee whiz, we're missing out on about 2% a year because we didn't have a process for and let me just add, I've got a formula, I've got an optimization calculator on Fidere's website. Please go use those things. Use them freely, be successful with them as investors, as portfolio managers, as advisors, whoever you are that's listening in any part of the world. I spent a lot of time building that stuff, and I want you to have it. So I don't come on this program and say, oh, look, do it my way. Here's our, we got the best model. No. The whole point of ASV Plus, ASV in general, but in this, this specific vein of ASV, is to equip you to make excellent decisions, to do things that you can't see to do, that your advisor may not even know to tell you to do, that portfolio managers sometimes run when I ask them to do. So, for goodness sakes, if you're going to miss 10% in this example on 2.2 million, as amazing as these people are, as worthy of every amount of credit and kudos you could possibly send to them for how well they did. And it's not that they did anything wrong. It's that nobody said, hey, what if we did this, this optimization analysis or some kind of more deeper dive into the relationship between risk and reward. That's where optimization lives. And I submit to you on one more point before I go to the market comparison from this example, that we can know. So if you're paying for advice on portfolios, you, the consumer, have got to be the one to bring this to your pros. Because as much as I admire and respect so many of them that I meet, and I enjoy their camaraderie, and they're impressed by their work, all of that, you got to be the one to bring it up. Okay, because it just, trust me, it goes better that way. So if you think there's even a small chance that you can pick up 1% per year on $1 million, on $2 million. I have an appointment this Wednesday for $6 million. Please go find a way to at least evaluate, right? Don't get a second opinion and a proposal from a broker that says, well, gee whiz, do my thing. Here's a hypothetical. And, I'll help you just transfer all your assets. No. That's not the conversation. The conversation is, how do we know, I'm going to go right here. Here it is. And we can set the market aside for a minute. But the third category of this analysis was the marketplace. So we have the investor, the model, and the marketplace in the same analysis. Okay. And that's what I want for you as a listener. I want you to see all that. Okay. So let's peel the onion back more. Standard deviation, I've talked about, it's total risk, business risk and market risk combined. Variation, volatility, right? Pick a word that you like. It's total risk. The investor had 14.5. Okay. So that was let me look here, an average historical risk score over the 5-year period. Our optimized model had 11.1. So the lower the better when we're talking about risk. And the marketplace was at 12.7. Okay, now remember I said the marketplace was a little ahead of our model in this example over the last 5 years by about 3% total in the 5 years. Okay, cumulative. The per year risk score, which is all I had, I don't have a cumulative risk score in this. The investor was at 14.5 per year, right? Versus their return. I didn't give a 5-year return average. It was 5.77. Okay. So just to play this out, if I have a 5.77% historical return on any amount of money, and I take the risk score of 14.5 solution, you remember the bell curve from, I don't know, high school, early college, maybe, right? In stats class, I think you were awake for that, right? Okay. So we take the bell curve and we go, all right, well, one standard deviation away from the median or the mean, 5.77 minus 14.5, 5.77 plus 14.5. What does that give us? Never said ASV plus was going to be as entertaining. Minus 8.72 to the downside. And positive 20.26 to the upside. So somewhere between negative 8.7 and positive 20.2, that's the range of returns that, looking at the history here over the last 5 years based on returns and risk, that we would expect for this set of holdings if it hasn't changed, going forward. So that's what, 65% of the time. Okay. So what does it sound like? Does it sound good? Sound bad? Compared to what? Right? So then we say, okay, well, the model generated 7.27. The risk score was 11. So now I'm just going to shorten this up. I've got 7 minus 11. I've got 7 plus 11. So I'm at somewhere between negative 4 and positive 18. Okay. Well, would I rather have a negative 8 or a negative 4 during a downturn? Not $1 million. Any amount. Let's go with the negative 4, yeah? Okay. On the upside, if we're getting upside to the tune of, in this example, 18% versus 20, and we've kind of preserved capital, in harder times when asset prices are lower, then we're taking off the peaks, we're taking off the valleys, and we're doing a more consistent job, right? Okay. So incidentally, the marketplace, a little bit higher on return. Average return was higher than the 7.27. It was up at 7.78, but the risk score was 12.7 instead of 11.1. So Sharpe ratio just tells us, we could go to Sortino, we can go to information ratio and some others for the PMs. But Sharpe is very widely published on multiple levels of software and reports that most anybody can get to. And you look at that and you say, okay, Sharpe is a combination, and think of it as a return premium for risks taken, right? Was there one? Yes or no? If yes, then how high was it? So the Sharpe ratio for this particular investor the last 5 years was 0.14 across all accounts, right? So remember, we're on the aggregate here, right? We're not on one account. We could do that. That's fine. Then we have problem children accounts, like that happens. But the Sharpe ratio for the model, which slightly behind on return, slightly better on risk, 0.32. All right. So more than twice, right? Sharpe ratio for the marketplace, 0.32. Same Sharpe ratio. So that's to say we're after all fees, by the way. Big deal. If I had a rant for this episode, it would have to do with fees, because this takes out every fee at every level, and it accounts for them. Let me say it that way, so it doesn't take them out. It accounts for them, and then we're getting net return and net risk, and we're using that net after fee on the accounts, on the model, and we're even applying it to the marketplace. And we're saying, all right, if the fee structure is what it is for this current set of holdings, for the optimized model and for the marketplace, and we apply the same advisory fee to all of those, and our fee at my firm varies between 0.75 and 1.25, and we do that, take all the fees out, what did you keep? So what happens is, when I can bring the market in, the index investing crowd often says, well, I should do the cheapest possible thing and look at my low internal costs. And you can find all kinds of airwaves and episodes and reels that say, don't ever pay for X, Y, and Z. Okay, I'm going to flip that coin and say, you ought to pay for what you get. So if you're not getting what you paid for, now you have a problem. But the fee itself is not your problem. So how do you solve that? Okay, I'd really like it if you would visit fideradvice.com. For you, we don't track anything you do. We don't even have to ask the question. It's not turned on our website. Cookies are of zero interest to Fidere advisors. So go to fideradvice.com or fidereadvisors.com. Look at the portfolio optimization calculator in the footer of that website. You can go back to our episodes from last year and listen to, there's a episode called Optimize Your Assets. It was more for the institutional crowd. And there was one called Finding the Value of Advice, which is for the retail crowd. All right. And I think we'll redo one or both of those, Lucian, by the way, as time goes on. It was an older format. So my concern there is that you know that you can measure the value of advice. Okay? And that sounds too good to be true. Like earth-shattering. In fact, let me just repeat it. Okay? You can measure the value of what you got if you paid a fee or any number of fees by using this calculator. You can know whether or not you have a return premium due to the allocation in your account, and therefore whether or not what you have is more or less optimal than something else. In this case, the marketplace. So let's just not have a fee conversation. Let's level it up. That's what we're doing here. And let's start to measure it and then have the conversation. Okay? Measure the value of advice. MVA, mean variance analysis. Get that score. Go to fidereadvice.com. Enter your aggregate deviation. It could be per account, but your aggregate deviation is ideal. Total risk, aggregate return, same time period. Risk-free rate of return, same time period. Do the same thing for the marketplace. Aggregate risk, relevant marketplaces. Aggregate return, relevant marketplaces. And use that calculator and find out, do I have a positive number or don't I? And how positive is it? So if it's there, whatever you paid, I mean, it could be more or less than some other place you could go or a thing you could do, but you're going to know very fast whether or not there's a premium due to the allocation. Okay, so who's in charge of that allocation is important, right? Are you in charge of it? Are you doing this? I mean, I would love to think that every investor I talk to has access to the tools needed to even generate those numbers and use the calculator. I don't think that's the case. I think advisors do and portfolio managers do. And I think that those are the people that ultimately you, the consumer who's listening, which is most of you, need to go out and ask, hey, can we please measure, or just take your reports and go do it? Measure the value of advice. Okay, so I got off track there on purpose. I want to dial this back to the marketplace and how in this example, the marketplace plotted along, right? And after fees, the Sharpe ratio of the marketplace and the Sharpe ratio of the optimized model were the same. Now, I'm not used to seeing that. I'm used to seeing the optimized model do a little bit better on Sharpe ratio, even 0.01. Okay. All it tells me is that nobody won or lost from an optimization standpoint by doing this versus what the market offered. So why is that? I have to dig deeper and spend more time than I haven't spent. But we certainly didn't do anything to lag after all fees from a Sharpe ratio perspective on the whole portfolio. And then when I compare that to what the investor had already been doing, just return wise, we said they were off by 10% over 5 years. Okay. And if that is 10% on $1 million, I don't think I need to tell you how substantial that is. And oh my goodness, again, this is not a felt need. This is not something you come to the Thanksgiving table. We had a good 5 years. Look, the thing at our 401k, that calculator said we're on track to retire. And, so-and-so, the financial rep that our family's known for, a few generations, who we like and trust because we're, in relationship, he thought we were doing pretty well too, or she. So I just want to steer you to another conversation here, right? To the conversation about find out, what am I getting for what I paid? Is it optimal? Is it not? What might I have missed? And just know that these dollars add up. And the typical thing I see, by the way, Lucian and you listening, is, 2% a year is a common miss on substantial sums of money. And I've said it before and I'll say it again. If you're missing even 1% or 0.5% on large sums of money every year after fees, please stop. Please get an ongoing second opinion. If you could find it outside of where our firm is offering that, great. If you need help, just find out, reach out, talk to us. You can go to fideradvice.com, sign up for Fusion is the name of the program. It's all over the homepage. You just register and we set you up in our system, and you don't have to transfer or have a single account managed. So we just start to do this for you every quarter so you can understand and bring this to your advisor. I keep saying I don't want to uproot people from good relationships, but I do want to enhance the decisions that are getting made. So this is ASV Plus. I wanted to give this case study some legs. I hope I've done that. I hope I've hit the salient points in what's here. And again, I'll post this tonight out at stewardsview.com. I'm trying hard to not go into every data point, by the way, because I think we'd be here too long and we'd have some people sleeping by the time we were done. So that's what I have for today. We've covered a lot of ground, Lucian, unless you have anything else. Okay. So it's just been great. It's been a joy to be back. I hope this session has been a blessing to you and others you decide to share it with. From all of us here at ASV, we really do look forward to what's ahead. Next week is going to be great. Paul Larson will be back with us. We'll continue the series called The Art and Science of Giving. That'll be Monday, June 29th and forward for at least one more week after that. So that's it for today. We'll see you out at stewardsview.com. And until next time, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.